Hey, Scott Barhold here, your profit and growth expert. And today we're going to be talking about which business entities are right for you. One of the questions I get asked by business owners all the time is, which business entity should I be choosing to run my business? What's better for me? And I have to be honest with you, the reasons to choose each one are different for each business owner. Things from liability protection to taxation differences. We're going to talk about some of this in just a high-level look for some of the different ones. There are 5 basic business types here in the U.S. They are sole proprietorship, partnership, corporation, also referred to as a CCorp, subchapter S corporation, also referred to as an SCorp, and then we have limited liability companies, which you may have heard called an LLC. These are the 5 basic business types that we have here in the U.S. Now, it doesn't matter which business type you choose, there are certain things that are individual, and the number one thing I'm going to share with you is any business that you choose, you should open a separate bank account. In other words, you should be paying your personal bills from your personal account and your business bills from your business account. Talk to your accountant, your attorney for different reasons for doing that. But the fact of the matter is you want a different account for your businesses. And if you have more than one business, you should have a different account for each business. All right, so let's talk into the different types that we have. Number one, probably the easiest to get started with is a sole proprietorship. Very easy to get started. It's inexpensive. The owner can make all the decisions. You can use the cash method of accounting, which means that you take credit for income when you get paid. You take credit for expenses when you write the check. It's easy to withdraw money from the business. You don't have to worry about setting up payroll if you're a single-owned business and you're the only person working in it. All profits are passed to the owner on a personal tax return. It's the easiest reporting requirements. Dissolution is easy if you decide to stop using the business. And the tax form used is the one you're already used to, the Schedule C on the 1040, and it's due April 15th, right? Makes it really easy. Some of the disadvantages, it's got unlimited personal liability. There is no difference between your personal assets and your business assets. The owner is responsible for everything, and a sole proprietor can only have one single owner. You can't bring on other owners to help, which makes it a little bit more difficult to raise capital, because the only way you can bring capital in is owner brings the money in, or the business borrows money and it's a loan. There's limited owner fringe benefits. The owner pays self-employment taxes on all the profits, and that goes on your 1040 as well. The business dissolves upon the death of the owner. So the business owner, this creates some difficulty if you're a married couple. If the one spouse passes away, getting access to the assets of the business, bank accounts and things can be difficult. There's a lot of paperwork. And a sole proprietorship, the business owner cannot be a W-2 earner, which means that you don't take a salary. W-2s are easy to do. Different states have some different rules of what they have to be. Like, for example, starting a sole proprietorship here in the state of Florida where I am, if my business name was Scott Barhold, I only need to get a business license. If I was going to be Scott Barhold Accounting, well, because the word accounting is not part of my name, now I also need to add on a fictitious name license. Now, funny thing, my sister-in-law was looking to do a sole proprietorship in the state of New York, and because her maiden name, she was using her first name, her maiden name, and the word designs. And when she went to get a fictitious name license, because her middle name is not in the dictionary, her maiden name, not middle name, her maiden name is not in the dictionary, the state of New York said, nope, you can't put that in a fictitious name license. So there's different rules for each state, but sole proprietorship is the fastest and easiest way to go. This is where you'll see a lot of real estate agents, speakers, trainers. It's very easy to get started with a sole proprietor. Now, some businesses you can't run as a sole proprietor. For example, in my state of Florida, if you're in construction at all, you cannot be a sole proprietor. They won't let you do that. So again, different states, different rules. Moving on. Second business we're going to talk about is a partnership. Also very inexpensive to start. And you have the ability to combine the resources and capital of unlimited business owners. You can have as many partners in a partnership as you want. Flexible partnership arrangements that we could say that everybody's even or 90-10 or whatever. Tax-free contributions and distributions from the partnership, including liquidation, which means that if you put money in or take money out up to your basis, you don't have to worry about paying taxes on that. Tax-free contributions, distributions, that's what we just said. All profits are passed to the owner and taxed on an individual level. So the partnership actually creates a 1065 tax return. Things come out and the business owners, the partners, are taxed on their personal tax returns. There may be certain limitations based on the amount of earnings, the pass-through earnings to the partners may be subject to certain limitations. Now, much like a sole proprietorship, a partnership has unlimited personal liability. In fact, and this is an important part of a partnership, each partner is 100% responsible for all of the debts of the partnership. So you could be in a 50-50 partnership and partner A doesn't have any money, so partner B is now 100% responsible for all of the debts. All right, regardless of what your partnership is, every partner is 100% responsible. Partnerships sometimes fall apart because disputes are common and can lead to business problems. Lack of flexibility to the fiscal year. If you're a partnership, you have to use a calendar year. That's it. You don't have a choice. Partnerships are limited to the life of the partners. If one of the partners passes away, it's gone. And partners are taxed on profits, even if they're not distributed. So if the profit stays in the business to keep the money running, to keep the business running, the partnership is still taxed. Each of the partners is taxed. And the sale of the partnership interest may be limited to a partnership agreement. For example, in this partnership agreement, before you sell your rights, you have to offer it to the other partners for first right of refusal, or they have all different rules. Again, talk to an attorney to get that taken a look at. A partnership may or may not be good for you. The next one we're going to talk about is C-Corps. Now, shareholders are protected against claims against their personal assets. One of the great things about a C-Corp or a corporation is that there is a definite distinction between personal assets of the owners, what we're going to call shareholders, and their business assets. So this creates what we call the corporate veil, and there is a definite difference. A C-Corp becomes a living, breathing entity unto itself. So it continues to go on. Multiple owners create a greater pool of management resources. You can actually do fundraising through offering stock and building it that way. Transfers of ownership are easier. You just sell stock. We see that happen with lots of different companies out there. Full deductibility of the losses. The corporation, now this is key. The second one from the bottom on the left. A corporation must have minutes from annual shareholders meetings and annual board of directors meeting. Those minutes must be put into the corporate book, and that must happen every year. Failure to do so, you could be violating your corporate charter. And if you were in a lawsuit or any type of an audit, the government can then turn and say, well, it's listed as a corporation. However, it's being treated as a sole proprietorship. It's actually being run as a sole proprietorship, pierces the corporate veil. It's being run as a sole proprietorship, and now there's no longer a difference between the personal and the business. This is a big deal. So some of the disadvantages, oh, by the way, there's an additional tax form for a C-Corp, and it is due on March 15th, not the April 15th. So there's a whole second tax return that's due. Greatest administrative burden. There's a lot of paperwork to do one of these. In fact, if you are a business owner employee, you have to set up payroll. There's a lot of things that you have to do. You can only get paid one of two ways, W-2 or dividends. The cost of an incorporation can be substantial. Double taxation, because the tax gets reported at the corporation, gets taxed there, and then the business owner may have to pay it individually on their return as well. Capital losses are treated for the sale of stock. In other words, when you sell your stock certificates, if there's a loss, and it's a long term, you won't be taxed at the regular income rate. You can get the capital gain, capital loss treatments. There's limitations on the use of the cash method, and the state laws vary from state to state of what some of the corps can and cannot do. So you have to be familiar with state law, but this is all under the federal. C-corps can be very cumbersome, but they are a great way for you to do asset protection. It's just one of the ways to do it. Next one we're going to talk about are the S-corps. Now, I want you to think about an S-corp as the perfect mesh between either a sole proprietorship and a corporation or a partnership and a corporation. Because in the corporation gets taxed. Well, and in a sole proprietorship or a partnership, the entity passes it through to the individual. Well, with an S-corp, it's a corporation that passes through the tax liabilities to the individuals on their return. It avoids the double taxation of the C-corp. So this is really a very popular choice. It's the ability to reduce payroll taxes with reasonable compensation provisions. Most cities, most states, you are required to pay your shareholder employees a wage. If you just post it to the K-1 at the end of the year, it puts you in a higher chance for an audit, and there's other things that can come up. Capital gain treatment of the sale of the corporate stock instead of ordinary income, just like a corporation. And you can withdraw as a shareholder, you can withdraw the equity of your business, the money that you've invested into the business, up to the extent of the basis that you've put in. So once you get into a zero position, you no longer have any investment in the business because you've taken out more than you've put in. You can no longer take advantage of gains or losses within the business. So that's kind of an important thing to keep track of. Fringe benefits, there are some things that if you are a shareholder that holds more than 2%, you are limited to some of the fringe benefits that you can receive. Pass-through losses are limited to the shareholder basis. Again, we just talked about that. If your basis in the company goes to zero, you can't take gains to the business, but you can't take losses either on your tax return, which could create problems. A lot of people, when they're setting up S-corps and these types of businesses, if there's a corporate loss, they use it to offset other taxable gains. Can't do that if your basis goes to zero. Again, something to talk to a qualified accountant when you're getting your taxes done. Make sure that you keep your corporation, that you have a basis in there. There's complicated rules and guidelines and regulations to an S corporation. Much like a C Corp, an S Corp, there's a lot of rules and there's a lot of scrutiny. These are the ones that get looked at. Now, different business types. For example, if you're a contract trainer, most contract trainers, most SEMCOs require you to be a corporation or an S corporation to run your business. So depending on what you need to do, this might be a viable way to go. The debt basis is limited to loans given to the S-corp by the shareholders. You can't use third-party loans as a debt basis. And an S-corp is limited to the number of shareholders, only 100 shareholders, depending on the business. This may or may not be a problem, okay? But these are different things that you can do. This is an S-corp. Moving on to LLCs, limited liability companies. One of the advantages we just talked about, if you're a subchapter S, you're limited to 100 members. But if you are a limited liability company that is being taxed as an S corp, there's no limit to the number of members. Now, I want you to understand that an LLC is not a business structure on its own. It takes one of the other four. Well, it takes either a corporation, sole proprietorship, partnership, or an S corp, and it gives you like an extra designation. So you get a little bit more leeway. Again, if you were chosen as an S corp, no limit to the amount of members. Limited members have limited liability. In other words, if you are in a limited liability company and you are a limited member, you get some extra protection. Let's say you and I are in this limited liability, and we are a truck driving company, and I'm a limited liability member. You're a member. I'm driving the truck, and unfortunately, I have a horrible accident, and somebody gets hurt. You are not responsible for the debts that I create. So that's one of the good things about doing this. Now, every limited liability company needs to have one managing member. Somebody has to be the person that steps up and says, by the way, I'm going to be the managing member because when it comes to fiduciary responsibility, there's something everyone has to have some holding. Now, if you're the only member of your limited liability company, obviously you're the one who's responsible. There's a lot of folks out there that are selling these LLCs saying, well, you have protection against against any lawsuits or anything because you're a limited liability. If you're the only one in there, unfortunately, you wind up having the unlimited responsibility. So please be aware of that. LLCs can have different classes of ownership, managing member, limited members. And remember, as a limited member, you are only responsible for your own liabilities, which is a good thing when you have multiple members. Okay. Tax forms will depend on the taxation and could be a Schedule C, 1065, 1120, 1120S. Some of the disadvantages, a lot of organizational operation requirements, and they differ from state to state. So once you do this overview, you may want to take a look at the state that you operate in. Members may not have limited liability in states that do not recognize LLCs, so that's important to understand. Earnings are subject to self-employment tax, and many states, California, levies a franchise tax. At the time of this recording, I believe it's $800 per year, just because you have an LLC in their state, especially if you're an out-of-state. If you operate in the state, but your residence is outside the state, or your home state is outside the state of California, it's like $800. Transfers can be difficult, and some industries like insurance and things like that are not permitted to use LLCs. So this gives you a little bit more, and it shows you how it's hybrid. LLCs are very, very popular right now, especially when it comes to some of those single members, because it does give a separation of personal assets. And that's one of the big things, the separation of personal assets as compared to business assets. You do get that. So what happens? You have a problem with your business. You're a single member LLC. You have the differentiation between your personal assets and your business assets. Unfortunately, something happens. The assets of the business do not cover the need, right? The debts that are created. So after they finish suing the business, many times you'll find yourself being sued civilly because there is a separation of business and state. Not to make bad news to it, but a lot of folks think, well, they can't come after me, but they do. It's what happens. If the insurance policy is not enough to cover the business, then they can come after you personally. W-2s or W-2 employees, LLCs, you can be a W-2 as long as you are qualified as an 1120, a CCorp or an SCorp. If you're a single member LLC being taxed as a Schedule C, you can't be a W-2 employee of that company, of that sole proprietorship, or if you are a 1065. That's why most of the LLCs that you do see come out are taxed as a corporation or subchapter S corporation. Again, I just tried to create something with a basic understanding, giving you a little bit of the differences between them. I don't know which is right for you. You'll have to make that decision. But sometimes folks would like a little bit of a sounding board because they have questions, and this brings it up. So if you still have questions, hey, don't be afraid to give us a call. Into the Black Accounting. You can reach us at www.intotheblackaccounting.com. Also, you can call 321-733-3778 or email us at scott@intotheblackaccounting, and we can help guide you through what works best for you. I'm Scott Barhold, your profit and growth expert, and I look forward to seeing you at your next event.